Hey everyone, this is Dana, and today, while I'm washing clothes, and that's the noise you hear in the back, I'd like to discuss funding the family bank. To understand this part of the series, it would make sense if you had seen parts 1 through 5, and the link is above. Because we have an established bank, and I'm retired, I would like to start by giving you the definition of retirement and how we funded our family bank. There are helpful resources and information in the description below. Please do not forget to like, comment, and share this video. Webster's definition of retirement is the withdrawal of one's position or occupation or from one's active working life. For our purposes, retirement is the ability to live off passive income. Now, a person can also be semi-retired if they reduce their work hours or workload. There are many different ways a person can retire. In this video, I'm going to concentrate on just two: the traditional and the modified early retirement. From birth, in the traditional retirement, you can train for 20 years, longer in some professions, work for 45 years, and then retire, hopefully debt-free with a pension. Of course, I did things different. I joined the military after graduating from high school, and ages 17 through 56 were my wealth building years. The reason it took me so long was because I did not formally start budgeting my income until I was 35. Unfortunately, I started at a zero net worth when I joined the military and went backwards. I had to dig myself out of the hole I dug. Please learn from me. Just because you have a steady income does not mean you are doing well if you can pay at least the minimum payment on your debt. I finally realized the tool used against me can also be the tool I can use in my favor. For example, if the debt can snowball, so can income. If you need a better illustration, please see part 1. The main difference is when you work and when you retire. Everyone is different, so this is what worked for me. I had to change my mindset. So what I'd like to do is do a comparison from the way I used to think to the way that I think now to help with the financial independence and to build the family bank. So what I used to think is the only income that there was, I knew there was more, but the main one that we had was the W-2 income, and that's all you needed. Now I see that what works is multiple streams of income to include passive income, which is income that I don't have to work for. I used to think that if I wanted something that I can either go buy it, put it on a credit card, or put it on layaway. So I changed my mindset from instant gratification to delayed gratification. So I didn't need that particular item or that particular service right away. I looked at doing more delayed gratification. I used to patronize other people's businesses. They made money off of my purchases. So my new mindset is to create and patronize my own business, the business that I created, whether it would have been a restaurant or retail. I would patronize my own business. How I used to think is that I was successful if I could at least make sure that I paid the minimum credit card balance or requirement, or whether it be a credit card or whether it be a financial institution, that I at least made the payment. Now I look to paying the credit card or anything that I have that has any interest attached to it, I pay that in full. I used to think that I was successful when I made my payments, so I was actually living paycheck to paycheck. I was basically using my checkbook to gear whether I was successful or not. Now I actually look at my spending, study it, so that I would find leaks or things that I did not need to be spending my money on, like interest and fees. And I made sure that I had a surplus that I was able to invest. Now, I watch television for leisure and I purchased books for leisure, whether they be hard book or whether they were electronic. Now, I have significantly reduced my television watching and I use the library for my leisure book reading, or they actually can loan you DVDs. So I use the library so I don't have to pay for the books. These are the leisure books I'm talking about. I used to dine out socially with my friends. Now I restrict my dining out to business meals. I did my own taxes every year. So now what I do is I study the tax laws and review the upcoming changes so that I can be smarter about my money. So this is just an example of changing my old mindset to my new mindset. And there's probably others, and there's some that maybe would benefit you. This is just an example. So with the mindset change, I actually put together what they call certificates of deposits with the surplus that I had. And the surplus came from my multiple streams of income. Okay, this is not meant to scare anyone. This is basically an illustration of my 20-year plan. So what I did was I took the money, the surplus that I had, and I actually started putting them in 84-month certificates of deposits. I paid attention to the credit union when they had specials on certificates of deposits. So to be fair, when I first started buying certificates of deposits from the credit unions, they actually started at 7.2%. It was later reduced to 5%, and now I have certificates of just over 3%. So what I did was I, again, had them at 84 months. So, and I spread them out throughout the years so that what you have is an illustration of 20 years of savings and rolling up certificates of deposits. Now, keep in mind, I'm doing this at the same time that I have other investments. But the reason why I want to show you this is actually the family bank and where we would be borrowing money from. And I'll explain that to you in the next slide. So when I have big ticket purchases, and this is outside of the house, because as I said before, I had it set up to where I could pay for my house within 5 to 7 years. Also, if I was purchasing an automobile, it would be at 0 to no more than 2%. So for my big ticket purchases, I did what they call certificate of deposit loans. So from the certificates that you saw previously, I would borrow against the certificates and then make the payments. Sometimes it's required on a monthly basis, depending on the financial institution and how they have it set up. But that's how I would make the payments. And I'll talk about that in the next slide. What it's called is a certificate secured loan. We have it set up in our credit unions. Each credit union that we work with does things a little bit different. So I'll kind of give you an overview. So with a certificate secured loan, you can borrow 100% of your certificate's principal balance at the rate of 2% above the certificate rate. For example, on the $100,000 certificate, and we usually use loans like that for our investments. If we were getting the certificate at 3%, we can borrow up to 100% or $100,000 at a rate of 5%. Now, some credit unions, for example, one that we have, it's 90%. So if we have a certificate for $100,000, we can borrow up to $90,000. Now, what's significant about that is that particular credit union says you don't have to pay any of the money back. So we usually use that for short-term investments. So we have a short-term investment, specifically a business investment for 5%, no fees. The approval process is 100% because you're basically borrowing the money from yourself, if you will. And if you do not make the payment, the worst case scenario is that the certificate is forfeited. So it's basically a win-win. Now, keep in mind, while you're paying the 5% in the scenario I just gave you, the certificate continues to earn the 3%. And that is one of the reasons why we open our certificates of deposit for 84 months. On one hand, you get a higher rate for keeping the certificate in the credit union longer. At the same time, we're able to borrow that money for a longer period of time. In part one, we talked about the power of passive income, whereas we illustrated the difference between paying interest and receiving interest. In part two, we talked about the financial institution and the role it plays in our family bank. In part three, we talked about the importance of credit and how we can leverage it to increase our family bank. In part four, we talked about how we use the family bank to pay for big ticket purchases. In part five, we talked about how we protect our wealth by using the different insurance vehicles. And finally, in part six, I talked about how we actually fund the family bank. This is an illustration that we use based on the time period. Things do change, but it's working for us, and any changes that we need to make, we will adjust accordingly. Thank you, and again, don't forget to like, comment, share, and if you have not done so, subscribe.